All right, y'all. We are going to apply the range deviation technique in a live example. All right, let's take a look at what we have here. So clearly, price was in some sort of range, and at some point, we decided to deviate the high. This would have been the original range. Price went a little bit higher, price went a little bit higher, then ultimately it broke down from said range with a very aggressive pull away. What do we know happens following an aggressive pull away? Well, based on the range theory, it makes sense to form at least some sort of consolidation because price is overextended following the aggressive fair value gap sort of candles or very, very aggressive bearish candles. And it is likely that at least on some time frame that we form a range soon. That's a very likely scenario, especially if this is contained within higher time frame price action. And let's take a quick look at the 1 hour. So yeah, this would absolutely be contained within some sort of higher time frame range here. So it would not surprise me based on the way that price has been flowing within the range. You have ranges here, ranges here, ranges here, up here, 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 here. It's very likely that, and look what happened in the last time we had an aggressive move down. A range, aggressive move, range, back up again, rotation, rotation, rotation. So that's essentially what we would expect. Now, is it going to happen right here? I have no idea. We're just going to watch and see where this decides to pull up a little bit. And from there, we'll start pulling a range. So far, price has taken a low. So it actually has done something because this was internal structure. If we had marked out the internal structure from the bottom here, you went down, you went up, you went down, you had that transition from left to right, ultimately ending with that high. This is your current structure. Up to here. So if we were to SFP this low, in theory, yes, this could become a weak targeted high. So that's something to note, right? So there was stop losses under this trend line. So from a liquidity perspective, it does make sense to form a range here. So it's not like we're picking in the middle of nowheres. Let's go down to the 15. And this is why I'm always patient. I'm always patient, waiting for the market to present viable trades. Otherwise, I'm not forcing a trade, right? I wouldn't just jump into this right here because there's no reason to. That's just foolish because we took a low from a previous higher low. It is what it is. I'm not touching that. Now, if we had have taken that higher low with some sort of notable shift in structure during this down leg, then sure, yeah, I would have taken it based on a retracement. But the problem is here, this is so aggressive, there is no structure. The next lower high isn't until way up here or even here. So you cannot justify that. So let's see what we get. So I would start immediately drawing my range, right? So we have between here and here. Okay, I'm going to take it up a little bit more. We're waiting for that equilibrium to be touched because we know we need 3 points to have a range. So now we have a range. We have a range. Now, this is where you're going to ask yourself, upon watching the videos that I explained about staircasing and all this other stuff, what looks like a suitable range and what does not look like a suitable range based on a time frame. So I can tell you that, yes, this may look like a demand zone right here, but because it's very, very internal and has not been confirmed breaking a lower high, then I wouldn't use that as a demand zone. So I'm not looking at that and saying, oh, wow, that has to be a good time frame to look at this range on. No, I would not, actually. I would not at all. So this is where I would go down to the 10. Do I see any kind of order blocks with imbalance here in the 10? No, not really. I'm going to go down to the 5. I suppose you could argue that there was an order block with imbalance, and it actually was respected right here. It was based on internal structure from left to right. You had an I boss here, but I'll just use break of structure because my template's a little messy. And then we have, obviously, a demand zone that was internally confirmed right here. So there is something, and we can actually use that time frame, no problem. Now, should we need to go down to a lower time frame, like the 3, the 2, the 1, following a deviation, depending on where structure is presented, then we can do that. That's no problem, right? That's no problem at all. But we have to keep in mind the target may not be the actual target. So if we come up to, say, here first, without touching that low, then realistically, the target is where? Remember, right here, right? It's not going to be down here per se. It would be here. If we break this low, then we can talk about this low down here. So we'll see how that plays out. But as of now, knowing how ranges play, I realize that there's 3 things that can happen. The 3 things that can happen, either A, we break up or break down. And this is not a tradable range. It just continues on its merry way, and we keep looking for new ranges. Scenario B is that we deviate the high. Scenario C is that we deviate the low. Or I guess there is a 4th option. The 4th option is that we stay within the confinements of this range, not deviating either side of the range, developing more of a retail value area before deviating, but ultimately deviating, right? That's very common. You're going to deviate. So in this point here, we can look at liquidity. So where is liquidity? Well, I can tell you now that we are curling down from the top. And if you were to wipe this range, you would actually have another range here. You could actually start from the high down towards that low as its own individual range. That's also possible because technically speaking, structure was pulling up on the lower time frames here. So you are allowed to pull from high to low and look at this as its own range as well. So this could be the range within the range essentially, which is fine, but we don't really, it's on a low time frame. We don't really have to worry about that too much. But you could, if you wanted to, you can look at that as well. For argument's sake, we're not going to because we're just looking for the bigger plays here. But if you're a scalper, by all means, you can go right ahead and look at these ranges within ranges all day. So what we're looking at here is the downward structure. So quite clearly, if we take the path tool from the high, we went down to here, made a lower high, and then made a lower low. So if we break this lower high, then there's the chance for the deviation on the high. If we break this demand zone, which we haven't broken it just yet, but if we start to lose this demand zone and we get significant closes below, maybe that's where price decides to finally come down and deviate the low. So we actually have closed below this demand zone, but it looks like we may be bouncing pretty aggressively from the extreme discount section of this range. And when you see something like this, where you have that nice sell to buy effect, you have a bearish candle that's immediately engulfed by a bullish candle. It makes you wonder if you missed something. There's a chance that we may have missed a demand zone on a lower time frame within the extreme discount section of this range. Let's go down and check. There is a wick here, and we know that wicks can be demand and supply zones. However, I'm quite far back in time, so there may not be the option to go to the 1 minute time frame. So I'm not going to have that luxury. I'm not going to push my luck with that. So unfortunately, we don't know for sure. TradingView would not have the data back that far, but we can assume that it is the extreme discount of the move itself. So there is a high possibility based on this wick that there is some sort of demand down here. So we actually do have an extension of this liquidity curve now, and we can draw that in. So where is your current structure? Well, let's follow on with that structure. So if this is your highest point before touching lower again, you went from here to here to here. So really, we are breaking structure now as we speak bullishly. And you could have found a scalp off of that, but I'm interested in the deviations. That's what we're here to trade. That's what we're going to look for. We're not going to look for anything in between. Deviations are high probability trades if done correctly. So price decided to come up. It took out all these highs, right? You broke your first initial lower high here. Therefore, this became weak. And then we came up to this high. We came up to this high. Now we have one more high to take out, which is the range high. So let's see how price does that. For now, we can actually draw in that transition. So we transition structure bullishly here. That's the lowest point, and then up to here, right? So we have a new structure drawing. We use green. So we're waiting for two things. A, we're waiting for the deviation above the range high. Now, it is fine if it doesn't wick the high, because it might not be a wick on the 2 minute time frame, but it could end up being a wick on the 15-minute time frame. A wick isn't necessarily required. If it does close structure above this high, we would just still need to wait for the market structure to break, right? Doesn't mean you can't trade it. It just means you're absolutely going to wait for that break. You're not going to chance it based on it being a deviation alone. Whereas if it was a candle like this, you could technically chance it. It is a riskier trade, but if it's in a high confluence area, you might bite on that. So we're not going to. We're going to do it the proper way. We're going to take the technique for what it is, and we're going to trade the technique for what it is. So let's see what happens. All right, so now we have a confirmed higher low. So what do we need to see? Well, now we need to see a shift in structure below this point. We know that the deviation structure is as follows. So when you have a created range, we'll just draw in a rough range here. You're waiting for the shift in structure above the range high. We're waiting for the shift in structure above the range high, and we're waiting for the transition of that expansion leg to justify that we now have a weak targeted level right here, which therefore you could expect full rotation, but technically in a situation like this, this would be the target, not this. If we had taken the low before the high, then obviously that would be the new target. And if we have this kind of trade, we're looking for what? We're looking for a supply range to form after the break of structure, and we're going to short the supply range. Now, this is where you can try to refine your entry. Maybe there's an order block with imbalance you want to take instead of using the whole supply range. That's up to you. For this example, we are only going to take it from the basic standpoint. We're going to use the supply range. We'll use demand ranges. We are not going to use the more refined approach because it's unnecessary. You can still make a lot of money with higher probability trades using the demand and supply ranges versus refined order blocks because they work a lot better. All right, so let's see what we have. So we have a shift in structure. We had a supply range being created. So this is now a valid supply range. We know that. And we have a move back within our supply range. Now, you could go down to a lower time frame like the seconds chart and wait for price to actually do this within the supply range and then enter if you want that extra confidence boost. But I'm not going to do that. I'm going to trust it for what it is. I know this is a range deviation, and I realize that this is a new targeted low. So from a risk reward standpoint, entering here, putting my stop above here, taking it down to this low here for a quick take profit is a 1.4% gain in my account balance, and it's a high confidence play. If we hit the whole range low, we're talking 1.77%. So I'll take that, right? Maybe we can average up for a better risk reward. We don't know. Let's try. In this case, I would say it's very unlikely that we would be able to average up because if we are to break out this high now, guess what? We break structure back bullishly. We should close the short trade. So new stop loss for me is above this lower high. So the new structure is back to red structure, bearish structure, and this is what you have. So the stop loss, maybe you want to put a little bit past that point just to be on the safe side in case you get an SFP. So my new stop loss is going to be here. So no longer risking 1% on the high, I'm risking a fraction of that 1% by putting my stop down here instead. So almost a free trade, really. So let's see if we hit our target. The initial target will be this low. We'll take out 3/4 here. Well, that's perfect. So at this point, you would have hit way more than your initial target. From a risk reward standpoint, using this theory, you would have netted a total of, let's see, I'm guessing at least 3% or close to it. Not very, very close to 3%. So the risk reward was 2.92%. So as you can see, this is a high confidence trade. Now let's see if we can trade the low. Now remember, we'll close that. But remember, we cannot use the same range. What do you mean by that, Phoenix? Well, I mean that you guys have to adjust your range. If you do not adjust the range, you're going to be looking at the same deviation points over and over again like this. You're going to try to trade this shift in structure and it's going to come up on you. And you're going to be like, what the heck? I trusted this guy with my money and look what happened to me. Yeah, because you didn't put this as your new range high. Please don't be that guy or that gal. Let's not do that. Let's not make that mistake. Let's pull this up. And we can actually put the original range template back on. Sometimes I hide my midline. It makes it a little bit easier to see, especially when teaching. So in that case, I'll put it back in. But now we can actually drag down the range low to this low because it actually came back in the range. Once you get it closed back inside, you can therefore move your range point down. So now we can move it down. There we go. All right, so let's see what we get here. Let's see if we have any kind of structure that says that we can enter a trade. Right, so far I don't see anything that we can enter on. Why? Well, because structure is this. From the high, it came down. To this point, here. I'm guessing that's a 1 minute lower high, lower low, lower high, and lower low. So technically speaking, because we haven't touched this low again, this cannot be a market structure break, right? We know that. That's not a valid break. So we need to touch that low again. Let's touch that low again. If we do not touch that low, then there's no trade to be taken. I'm not trusting this deviation without something that says, hey, it's going to work. I don't have that confidence here. However, what we could do, now that we came up that high, is we could look for a scalp trade using the internal fractal structure between this point and the low. So if price continues on its merry way like this, and you get a shift in structure down here, we can enter either on the break or on the retest of the demand range. And from there, we can take it up to this point because that would be the targeted level using that structure drawing that we're currently dueling out. If we hit this guy, we get a close above, it could do what just happened here, where you just smack right above to the range high, if not higher. So let's try it. I don't see why we wouldn't try that. So far, the structure from a fractal standpoint is down and up. We don't have any other structure to go with. Now we have a new lower low. Even though it's only a wick, it's still a lower low. We came up and made this lower high, lower low. We have two candles in a row that are both pointing up here, so we can actually use the highest point. But it's not valid yet. We still have to wait. Now it's valid. So now we have another lower low. Okay, let's see if we get that transition. So now this was the lower low, and this would be the lower high to break. So we can try entering a little bit on the break itself if we get it. and we can enter some on the newly formed demand range, or we can try to refine down to this order block with imbalance right here. Now, again, does it mean it's going to get hit? No, it does not. Okay, this does not always get hit. Now, let's zoom out to see what's going on here. Let's go to the 5 minute very briefly. So in the 5 minute time frame, this is what we have. It's not exactly what we have, it's close. So we had a swing high, we got a swing low. We already took out the high right here. This is already done. We rotate it back down. We rotate it back down. And then we took out the low. Actually, it was originally taken out here. And then we came up a little bit, formed some sort of structure, came back down again. And essentially, we're targeting up to this midpoint roughly for a trade. And then from there, we'll see if we get the rest of the trade. So obviously, the same rules apply. I'm incorporating market structure. I'm not trusting the deviation blindly like a fool. Okay, we want to see evidence here. The alternative to using the order block with imbalance is obviously using the entire demand range. We know this whole thing is a demand range. So we can overlap if you'd like to. It's up to you and how you want to go about this. I can't tell you guys how to take your trades. I can tell you how I do it. And this is how I would go about it. I'll scale in a little bit here. Doesn't look like price wants to really lose that level so far. It might not hit that order block, but if it does, we'll add in. Okay, oh, look at that. It actually did. So this is where I'll add into the trade. And we'll ride it up from here. All right, so we just about hit the first target. Very, very close, and we're starting to decline down. So this is where I'll tell myself, okay, based on the fact that we're seeing a decline prior to taking that high, we could very well have a lower low, lower high, lower low, lower high, lower low situation. And because of that, I'm going to scale a little bit off here, just so I'm not walking away empty-handed. I'll put my stop loss to break even every time we come back to this midpoint of the range. Even if it breaks my market structure rules, I don't care. It's a safer way to go about it, and that's what I'm going to do. So I'm already locking in a guaranteed $329 in this trading example, right? So I'm not walking away empty-handed no matter what. So let's see what we get. We technically hit the target to the dollar, producing equal highs. Now, if we do decline down here, technically speaking, this would be the valid stop loss because your structure is now this. If you follow along with this red drawing, it went up to, made a higher high, made a higher low, and it made a higher high. Now, you could argue that it technically just broke structure here, but if you went to the 5, that may not be present, or even the 10. So on the 10, that's not present, right? So very well could be making a higher low in the 10. So let's keep that in mind. The 10-minute structure is as follows: higher high, higher low, and a higher high. So let's move the stop loss from break even. And we're going to move it down a little bit, knowing that we have money to play with now. So we'll move it down to that low, and we'll see if we get that rotation back up or if we get stopped out of the trade. Okay, so obviously it's still having quite the difficult time here. If we break this high, I feel that we'll have a great chance of coming up towards that range high. And I'll be taking profit on, right about here. I'm going to cut some more profit out because I'm seeing that price action is trying to curl over a little bit. And we don't want it to round off and take us out of the trade. Let's take a little bit more profit. We're not going to be too greedy. Okay, now we're breaking that high. Okay, we're coming up towards that range high. I'm going to shave one more off here. And if we hit this level, then I'll shave the rest off. But you know what I'm going to do? I'm going to front run it ever so slightly. So I'm not greedy about it, right? There we go. Okay, that's good enough. We would have hit our last take profit. We walk away with almost $1,100 with $100 risk. Very, very nice trade. There you go, right? Very simple deviation trade in the bag. From here, we could do the same thing. We could try the same thing again. But remember, the more times you deviate a range, the more likely it is to break out when it hits the other side. It's not going to keep deviating, right? You're not going to keep deviating. 2 times is nice, okay? 2 times is great, but you don't really have to aim for 3, 4, 5, 6, 7 times. That's not likely. 2 times is likely. 1 to 2 times is fair for a quick 10, 15-minute range. But again, I wouldn't expect it to keep rotating. It could very well fill the rest of this fair value gap now. On the other hand, there is a lot of liquidity under us. You can draw a liquidity curve here. So there is the chance that it does rotate back down. So what do we need to see? We need to see this level loss right here before we touch a trade. Why? Well, because market structure from the low, that would be your last higher low. I'm not going to draw all that in again. I'm going to skip past it up to this higher high, to this higher low, to this higher high. That's our 5-minute higher low. If you really wanted to, yes, you could use lower time frame structure. But if you were to dissect the structure between here and here, your target's going to be here. So I don't know about you guys, but I'm not really interested in a $100 market structure move. It's kind of chancy given the circumstances with the fair value gap here. So I'm not going to do that. I'll wait to see if this breaks. So it did not break. Now price action is going higher. you would have moved your range high up to here because it closed back within. And, if it keeps breaking up and breaking up at that point, I would just call this range quits and I'd watch for something else. So it actually has transition market structure here, but you did not get a retest. I forgot to move the higher low up. The higher low should have been here. Doesn't matter anyways. There was no retest. So what do we have now? Well, we have a supply range. Once again, it's quite large. I won't deny that it's quite large. It could also be a higher time frame order block with imbalance. And look at that. So far, it would look like a 30-minute order block with imbalance that's not yet confirmed fully. Now, obviously, you're going to be careful here as well, because there is a chance that you actually broke structure on a higher time frame. So this is where I'll actually hide the range temporarily to see what the heck is going on with market structure so that I'm not missing something here. Because there's a good chance we did, and we don't want to miss that. So we went down, we came up to this point, price therefore went down again, and then it actually closed above. See? So even though, technically speaking, we have broken structure here, that doesn't necessarily mean we're going to rotate all the way down to here again. We could, but doesn't have to. And the reason why it doesn't have to rotate that far and take that out as a weak low is simply because of what I just showed you guys. We have a 30-minute break in structure. This is a valid break in structure. And this is why you have to flicker your range off and on sometimes when you're looking at strategies like this, especially after you get, one side being hugged to that extent. So it was hugging this one side for quite a while versus this quick deviation and this quick one where it came back in right away. And then it broke out again. Whereas this was only a wick, right? So when this closed below, it actually came up and then took the low again with the wick. That was a key signature for a nice deviation. Whereas this guy here, he actually closed above. He didn't wick twice. So this could be a higher low, higher high kind of play. So you're going to be careful with this. Now, the only way I'd short this guy here, given the circumstances, is if we have some sort of internal shift. If we get this on a lower time frame, I would therefore short it. So I'm looking for yet another confirmation. It's basically a double confirmation if you think of it. So we got confirmation 1, we're looking for confirmation 2 now. If we get confirmation 2, we can indeed look for shorts down, but I'm not going to target an unrealistic area. Based on the new 30-minute structure, I would target something like this little order block with imbalance down here. If we go further than that, great. If we don't get a structure change and I miss the short, so be it. Who cares? There's going to be way more of these range trades. You wouldn't believe how many of these setups are available every single day across thousands of assets. It's insane. This is the best setup there is, period. Such a high confluence setup. When you start incorporating this with supply and demand flips, that's when you get the real sauce. But we're not doing that today. We're just looking at the basics. All right, so structure looks like it may be making a lower high, but if we break this low here, we're not going to hit our supply range. Or if we do hit the supply range, it's back to bullish again. And this could be a higher low for a higher high, right? So unfortunately, the idea was correct. There just was no entry. And guess what, guys? That's a part of it, right? This is a beautiful example because it's a part of how I trade. Sometimes there's no entry. You have to be patient. You have to have discipline to not rush into things if there is no true confirmation or there is no retest. Because by the time you would have entered on this 15-minute close down here, back within breaking this 15-minute structure, or I think we said 5-minute structure, either way, yeah, even 5-minute structure, your risk reward was not that great. So if you had have entered, even like say here, realistically, it's close to the supply range, but it wasn't beautiful. Whereas you could have, in theory, waited for that reconfirmation, which would have gave you a much, much, much cleaner risk reward using like 1-minute, 2-minute structure. Getting a break like that, entering on that break would have netted you a lot more. For example, like you could be talking, say, 5-6% versus that 1-2%. But in this case, we stuck to our plan. Our plan said no entry just yet. We missed the trade because of it. It is what it is. Very easy examples. So you guys know how we go about trading it. Theory is one thing, but seeing the examples is something that I think most people need to see, and how I run through things. Otherwise, you're not really going to get it. And trust me, I've been there. I know that. That's why I'm doing it, my course in that motion where I'll show the theory for each thing, but then I'll show you guys how to actually go about it.